Wonderful. Well, thank you so much, everyone, for joining us today. Really appreciate it. I think this is the 12th session of our month of insight into games here at UKI. So delighted to be joined by Catherine Davis of Urban Ledgers, here to talk to us today all about well, VGEC basically and claims in the real world. So Catherine, do you want to take things away? Should we
Yeah,
make a
of
start?
course. Yeah. Thanks so much, Leo. Thanks for having me back to talk about VGEC. So first of all, just a short intro about us if you don't know us already. So we're a chartered accountancy practice. We've won multiple awards in the accounting space. And interestingly, we only work with video games. So that is our micro niche. All of our clients are game studios, which is absolutely fantastic and exactly the type of clients we love working with. So we can obviously do VGTR and VGEC claims, but we can also do all compliance work, BFI certificates, and essentially act as your outsourced finance team. And we have been now submitting VGEC claims to HMRC, which is still pretty early days, but we have sort of enough data to bring you some insights into what we're seeing happening from the front line. So lots of juicy content to run through today. So, oops, sorry. Oh, come back a few there. So what we're going to cover today. So just to give you a really quick recap, because I know a lot of you already understand to a degree what the differences are between VGTR and VGEC. You would have heard a lot about that over the last year. And I want to just recap what's actually changed there. A question that we see all the time coming through is, should we still use an SPV? Are they still worthwhile? What are the new requirements around using an SPV? It's a little bit more complicated than it was previously. So I just want to chat about that. Used and consumed, everyone's favorite. The rule is so grey, but I'm going to set out what it means in practice and what we're seeing at this stage. I want to also talk through how to prepare for a robust claim, and associated with that, of course, is how to minimise the risk of an inquiry from HMRC, which of course nobody wants. There is an increased risk exposure under VGEC. So I'll talk you through the powers that HMRC now have. And then I'll just cover a little bit more about why the market's moving away from in-house claim preparation. So to get us started, just a really quick refresher on VGEC versus VGTR. So obviously VGTR fully ends in March 2027. It's sunsetted then. So from 1st of April 2027, all studios must claim under VGEC for new and existing projects. VGEC, of course, was brought in effective the 1st of April 25 for any new projects that started development after the 1st of April 2025. So a couple of reasons for that, obviously Pillar 2, and the government obviously wants to boost the skills in the UK and drive innovation. That's really critical for the government. So the effective rate is pretty similar under both regimes. The mechanics behind how you claim are different from a tax and accounting point of view, which I won't go into. Really the important bit here is the effective rate. Previously 20% under VGTR, VGEC marginally higher. What's really important, obviously, and you're probably well aware of this, is under VGTR you could include UK and European spend as core expenditure. Sadly, under VGEC, it's only UK spend, but there's a caveat to that, which we'll come into later. I guess in good news, obviously VGTR had £1 million subcontracting limit per project. That's been done away with under VGEC, which is great. And under VGEC now, you must have a minimum of 10% spend in the UK, whereas previously you could have a 25% UK European spend under VGTR. So that requirement has dropped slightly just because the spend has to be in the UK. Connected party scrutiny, this is an interesting one. And if you operated with a SPV under VGTR, you would have known that there was always concerns about how the connected parties interacted with each other. So this is in the instance where you've got a parent company that owns 100% subsidiary being the SPV, and those two companies transact between each other. Obviously, they must transact at arm's length, but there's new stricter requirements around that. which I'll cover off shortly. And in terms of qualifying spend, VGEC still has the 80% cap on qualifying expenditure, as was the case under VGTR. So hopefully that is ringing some bells. In terms of timelines, which I covered briefly before, so if your development started on or after the 1st of April 25, you have to use VGEC. And the development start date is a really interesting one. So if you're doing, I guess, essentially concept design work, that is not your development start date, that's still concept. So you have to be really clear as to when did you actually start development. And there has to be evidence around that as well, because HMRC are looking for instances where a company is claiming under VGTR, but in reality, their development started post 1st of April 2025, and therefore they should have been claiming under VGEC. So it's just something to look out for there. For those projects that were already in development at 1st of April 25, you can still claim under VGTR if you want to until March 2027. And we're seeing a lot of studios still doing that. And that's purely because of the European spend element of it. It's more lucrative generally to claim under VGTR if you have those European contractors or European agreements in place. And if you are running multiple projects with various start dates, you can still run some under VGTR, some under VGEC. It's going to depend on the individual project itself, and also the overall corporate structure that you have. If you have any overseas entities, for example, that's going to impact on whether you claim under VGTR and VGEC. So you just need to look at those individually at this point while you still have a choice to use VGTR and VGEC. So some analysis would be required around that just to see which one's going to be more beneficial for your studio. And yeah, as I say, be careful with the start of development date. So ideally you have some documentation around this, a board minute, for example, production notes, whatever it might be, just documented, because if HMRC come looking for it, they're going to be quite interested to see that evidence.
Catherine, could we just backtrack a little bit? Oh, maybe you're going to come on to this.
Yeah.
Maybe talk through what an SPV is. And,
yeah, of course. Yeah.
And also what defines arm's length as well.
Yeah, certainly. Yep. So that was a good segue, actually. Thanks, Leo.
Okay.
So claiming through an SPV. So let me go back to basics here as to what an SPV structure might look like. So you have your game studio in the UK. That's your primary studio that employs a number of staff. That's called the main company. You may wish to set up a 100% owned subsidiary, which is in effect a special purpose vehicle. And that's going to act as the development company for your studio. So it's going to be the video games development company, and it's going to be that company, that SPV, that claims the VGTR. So the reason for doing that is, funnily enough, on this slide here, there's a couple of sort of admin reasons, but the main reason is financial. So if you operate through an SPV, you can have an SPV per game, which is the cleanest way to do it. And that allows you to keep a clear P&L per game. And also, if you want to run multiple VGTR or VGEC claims during the year, which a lot of our clients do for runway purposes, it's much easier to change the year end of an SPV, which is only really just transacting with the main company. That's generally all it does. So it's much simpler to shorten the accounting year end for that SPV than to shorten it for the main company. Because of course, when you shorten a year end and you put a claim in, you still have to submit a full set of statutory accounts and corporation tax return. You're not submitting the claim on its own. It's a full year end, but it's much, much simpler and way more cost effective to change the year end and do accounts for an SPV because the transactional volume is much lower. And what's actually happening with the SPV and the main company is the main company employs the staff, and the SPV is contracted to do the development work. So the main company will lend the SPV its staff. In return, the SPV will perform the development function for that main company. So there's agreements, there has to be agreements in place between those two entities, which is really, really crucial because they have to transact at arm's length. So the purpose of all of this, if you like, to sort of cut to the mustard, is you can recharge at a slightly higher rate because you're recharging at arm's length. So normally if you're recharging between a parent and a subsidiary, it might be at cost. But you are allowed to recharge at arm's length rates. And that has to be evidenced by external, say, for example, market rates or rate cards or various other documents that you have. But effectively, it means that you can mark up the costs to increase your claim. And that markup might look like 5, 10 or so %. Just depends on the individual situation and a lot of other factors. It's essentially, the derivation of that rate, that recharge rate is really, really critical because you don't want it to be too high, and HMRC will query it and it'll be unsubstantiated. Equally, you don't want it to be too low because otherwise there's no point in running the SPV at all. So it's a relatively straightforward arrangement, I guess, once you can get your head around it. But essentially, it means that you can increase your claim by marking up your cost to, market rates or arm's length. And then, as I've mentioned here, the documentation requirements have increased under VGEC, which we'll come to in a second. So what do you need to run your SPV? I mean, this is the same as if you're claiming VGTR. You need to have these 2 key legal agreements in place. This is bare minimum. So one's a video game development agreement and one's a lending and an assignment agreement. And that just evidences that the main company is lending the staff, the SPV is acting as a video game development company and is providing video games development services to the main co. It has to be really carefully worded. It includes timeframes of payments. It includes what's called a man-month rate, which is just an average rate for each staff member. I would very, very strongly suggest you get your legal team to draft these for you, because they also might see opportunities for licensing recharges. So if the IP's being licensed down to the SPV, you need to have an agreement around that as well. So not only will your lawyers see that you have to have the VGTA and the LAAA, you have to, in some cases, have other agreements as well, depending on what you're trying to achieve. They'll often see opportunities to have additional recharges coming down into the SPV, so well worth getting their advice. What is new under VGEC is really the need for a formal transfer pricing agreement or a transfer pricing policy. And the point of this is to document the intercompany transactions, and insofar as evidencing that they are at arm's length. So previously it was good practice to have this under VGTR. Now under VGEC, it's really, really essential. And generally you would have a TPA where you've got a complex corporate structure. We have international subsidiaries or related parties. A formal TPA is really, really important. A transfer pricing policy, just think of that as sort of a slightly lighter touch policy. It's not as complex as a TPA, but both are documents that need to be, either one or the other needs to be drafted and ready for HMRC if they come looking for that. So things that might be included in a policy, so it may be the background of your corporate structure and what each company does within that, the nature of the services being provided between the companies, the methodologies you're using to price those transactions, what forms your cost base, like what type of expenses are included in your cost base, the benchmarking against other companies, market rates, and most importantly, any existing third-party agreements that you might have. So as an example, if you're doing work for hire and you're charging out your staff at, say, $7,500 a month, if all of a sudden you have a transfer pricing policy that is recharging between your two companies at $12,000, then HMRC are going to be quite interested in that. So you have to make sure it's pegged against your existing agreements with third parties. That's really, really important. And then also in that pricing policy, you should include a log of all your supporting evidence that you have to support the rate that you're using to perform those intercompany transactions. The markup, if you like, on those recharge costs, it has to be relative to the cost base. It can't be unrealistic. You can't have, a 30% markup on costs. That's too much. So you just have to be really careful where this sits and be able to evidence it, because HMRC will be interested in that. And finally, you're probably aware of this. Before you actually start transacting, you have to have the companies in a VAT group. And the reason for that is because you don't want to give rise to having to charge VAT on your intercompany invoices, which can cause a cash flow issue in terms of payment versus receipt. If you can set up a VAT group, essentially no VAT's charged on those intercompany transactions, which means there's no physical payment of VAT over to HMRC and no waiting for a refund from the other entity. So, get that VAT group in place and just be careful, because it's taking HMRC. We've seen instances of even 3 to 4 months to set up a VAT group. So it is a significant lead time. So if you are thinking of setting up an SPV, that would be one of the first actions I'd suggest doing, is just getting that VAT group set up. Does that answer the question for you, Leo?
I think so. There's been another sort of question in the chat here about SPVs. I suppose potentially conflicting with funding opportunities like UK Games Fund. So I wondered if you'd encountered anything around that at all.
Yeah, I mean, I wouldn't say they are conflicting insofar as you can still apply for the Games Fund, having an SPV in place. I think what's important to note with the Games Fund as well is that, and this is something not all studios are aware of, that if you do succeed in getting a grant, you can't actually claim VGTR or VGEC on that money. So perhaps that's what the person meant by a conflict there. But yeah, you can only excuse me, you can only claim once on the cost. So if you're receiving, say, 250,000 in a content fund grant, you then can't go and claim VGTR or VGEC on that 250,000, because effectively you're double dipping, which isn't allowed. But having an SPV doesn't preclude you from seeking the content fund grant. You'd apply for that grant under the main company. You'd have to disclose that you have an SPV, but it's the main company that would be applying for it and seeking the benefit of that. And it can stay away from the SPV because, as I say, you can't claim VGTR on it anyway. And that's the main company is obviously where you've got your staff employed. And that's what, the UK Games Fund want to see. They want to see some staff in place. So yeah, effectively that application would be from the main co itself.
Okay, fantastic. No, that's really, really helpful to understand. The only other question that we've got right this second, which is fairly pertinent, is around the VAT groups. So, is it an absolute must that the VAT group has got to be in place, or is it just preferred?
It's absolutely preferred, and that's because, I mean, ordinarily, studios are pretty cash poor. The runway is always really, really tight. But what's happening is you're doing intercompany transactions between the two entities, and the company that has to pay VAT over will pay VAT over probably 3 to 4 weeks before the refund is received in the other company. So you've got a time, particularly if you've got a large project underway, you've got a time where that cash is not usable nor available for use in the company as working capital. So to avoid that, I mean, to avoid even the need for reporting anything from the SPV, the VAT group just makes the admin so much simpler. But if you don't have that VAT group, then you must account for the VAT at 20% on each of those transactions.
Got it. No, that makes a lot of sense, especially in terms of that waiting time.
Okay, so let's just chat a little bit more about transfer pricing, which, as I say, it's really, really critical now under VGEC. So you have to transact with connected parties at arm's length. HMRC are getting really hot on connected parties, not just for VGEC, across personal tax, everything. Connected parties is huge for them at the moment. But essentially what HMRC is saying is if your transactions between your connected parties aren't at arm's length, then that profit element will be excluded from your qualifying expenditure or your core expenditure. That's probably the best case scenario. If they find that you are deliberately misleading them, or they feel there's an element of fraud there, then they can wipe out your entire claim. So that's why it's really important to make sure that that rate between the parties is correctly calculated. And obviously it can move over time. It doesn't have to be static. It can depend on, obviously the market moves year on year. So it has to be reviewed quite regularly, particularly before you're about to put a claim in, to ensure that it is, reflecting the current market rates and also reflecting what's happening with your other third party agreements, because they will change in terms of pricing as well. The TPA or TPP we spoke about, it's an essential, one of those is an essential document, whichever one you choose. TPP is great for UK-based studios that just have a UK SPV. Really, really simple vanilla structure. A TPP is absolutely fine. The supporting evidence you need to keep: rate cards that you might have issued to other studios for work for hire, as an example, any quotes, market surveys, benchmarking, third-party agreements, anything at all that can benchmark your pricing, keep it, and reference it in your transfer pricing agreement or policy. As I say, if you do have a larger group of companies, you have to consider the rate in the context of all of your group agreements, not just the games entity or the video games development company. So, you have to look across the entire group to ensure that that rate that's been calculated is truly arm's length. So, as I say, work with your lawyer, work with us. It's not simple, but it's really, really key to get it right. And I would say here, do not just do a blanket markup of 5% or 10% or 15% of your cost base. It just doesn't work like that anymore. So we're going to move on to another juicy topic: used and consumed in the UK. This is another area that's caused masses of confusion. And it probably will for, I'd say, another year or so, because at the moment we've seen, a relatively small number of studios claim under VGEC. So the use cases are still relatively low. And I think even HMRC are really trying to get their head around this. But this is our take on it at this point in time, and this will evolve over the next year or so. So for those of you who don't know, under VGEC now, the qualifying expenditure must be on goods or services used or consumed in the UK, which is quite woolly. But generally speaking, if the work's performed outside the UK, it doesn't qualify. However, there are, of course, exceptions to that, which is where the grayness comes into play. So it's not just where the work's performed, it's whether the services facilitate UK development activity. So if, for example, your overseas contractors, co-dev partners, or whoever that outside of the UK body is, if they're only producing an element of work that's then further developed by the UK team, it can potentially qualify. But if they're doing a job or a piece of work that's a standalone deliverable, i.e. it's complete in itself, it doesn't qualify, even if you end up incorporating that into the final UK game. And that's because nobody in the UK has done anything with that work that they've delivered. So, it's not used and consumed in the UK in that instance. The UK development team would have to, modify that or, make amendments to it, to quite a large degree. And this comes down to the contracts that you have with your non-UK contractors or development partners. So that's another area which needs to be carefully considered when the contract's being written up. What is it? What's their remit? What are they delivering? Is it complete in itself? Is it going to be truly an input into the UK development team for further work? And the more that you can make that clear in the legal agreements, the better, because then that will help form your case to HMRC. If you do end up claiming a portion of their costs as used and consumed in the UK, then any evidence that you can provide to support that is going to be so important.
In terms of, just out of curiosity, we've had another question in the chat here, which I think is fairly pertinent right now. If we have a UK citizen, a solo developer working from another country for 3 months, but all their infrastructure is in the UK, pay themselves in the UK, just not physically in the UK themselves, I'm assuming that's still falls within the scope of making these claims.
So that's an interesting one. So physically sitting outside of the UK for that 3-month period. Yeah, I think, I mean, you'd probably need to look, well, we need to look into the minor details of that one. I mean, they're employed by a UK company, but physically sitting overseas. It's a tricky one. If HMRC looked at that and actually realized that they were located outside of the UK, then they may question that. So they want to see people in the UK paying UK tax, obviously, which I assume this solo developer does. That's the cleanest way to do it. If you're sitting abroad, if they dug into it, there may be a case for it. But if you're a UK taxpayer, I don't think they'd get particularly excited if it's for a short period of time. If you were based overseas for years, then they wouldn't be very excited about that. But if we're talking a short time of 3 months or so, and you're ordinarily resident in the UK and you're a UK taxpayer and your company is based in the UK, I don't think they'd take too much exception to that. I think that would be okay. But you would have to look at it case by case and develop a case and be ready for them to ask you, why are you claiming those costs if you're not based in the UK? And do you have a team in the UK that's then using your work to further develop, which it doesn't sound like there is. So you just have to tread a little bit carefully there. So here's some examples of what might qualify and what might not qualify. So what might qualify: some artwork that's done outside of the UK for the UK team to build some assets. So that art is fed into the UK development in a raw form, and the UK team developed that further. Same with the sound of the audio engineer. The sound stems are integrated into the game, potentially further developed. QA tester overseas provides bug reports, which is then used by the UK team to direct fixes. So in those cases, that expenditure would likely qualify. Where it wouldn't likely qualify, coming back to these standalone deliverables, and this is particularly relevant for co-dev studios who, typically do develop standalone work, particularly where you're porting. So complete character models which aren't used for further development, so they may be used in the game still, but they're not developed in any way further by the UK team, or if they're developed minimally by the UK team, you could claim a very small proportion potentially, but you would have to be able to prove that, and that proof would come through, as much as I hate to say it, possibly a time log or some sort of timekeeping record of the UK team developing that work further. Again, if an overseas contractor builds or delivers an entire game mechanic or mode independently, that's not going to qualify, as neither would shipping, writing complete code for a feature. It's pretty grey, that's all I can really say, and it is very much case by case. But as I mentioned, what really does inform it is the agreement that you have with that contractor or other third party. It's got to be written in a VGEC friendly way, if you like, if you wish to claim some of their costs. And it's not black and white. It's not like they will 100% not qualify, or they will 100%, their costs will 100% qualify. It can be a proportion, but that proportion has to be based on a set of assumptions or facts that you can evidence. It can't just be, well, I think it's 50%, and HMRC asks you why, and you say, well, it just feels right to me. There has to be. So sadly, they're not really accepting answers like that. So it has to be quite well thought through. I would definitely talk to your law firm about these agreements. They can create one for a contractor. The co-dev ones are obviously more complicated. You'd be working with your law firm anyway. But try to make it as VGEC friendly as you possibly can, where you can. In some cases, it's sadly just not possible. So any questions on that, Leo?
None at the moment. I mean, there's another question about SPVs.
Okay.
Which is so if a main company has significantly less than 100% in SPV, for example, shares given to developers, investors investing in one particular game, does that change things at all from HMRC's perspective?
No, I mean, that's quite a common situation where you do have that main company and you've got many external investors, which has diluted the founder's holding. That doesn't matter. That's absolutely fine. You can still have that 100% subsidiary, which acts as a development games development company. That's absolutely fine and quite common. So HMRC, don't get excited about that.
Good to know. Thank you.
It's okay. So let's just move on to now preparing for a robust claim and just getting the foundations right from the outset. So before anything else, is your structure fit for purpose under VGEC? It may have been okay under VGTR, but is it okay for VGEC insofar as if you're about to start a new game, do you want to set up an SPV? Is that going to be worth it for your studio? Generally, it works well where you have, a couple of people minimum in the main company. You've got a decent sized development budget, generally sort of 100K plus for the life of the project. That could work well. Even if you're not sure, it's worthwhile just getting a bit of advice on that because, you may be surprised at what the difference is that it makes to have that in place. You just have to balance that, having an SPV, there's going to be additional costs. So there's legal fees to get the agreements up and running. There's accountancy fees because you have another entity, albeit a much simpler entity. There's still going to be fees to, to prepare the annual accounts and the corporation tax return. But normally those additional fees are dwarfed by the benefits that you can get from the SPV structure. So yeah, have a think about that. As I say, larger projects, definitely worthwhile, or where there's multiple games. Your TPA and TPP has to sit coherently across the whole group. So if you have a more complicated group, that it may include a game studio amongst other types of companies that run in different industries, for example, you have to make sure that that agreement sits coherently across the whole group. It has to align. You can't just look at the agreement between the main co and a singular SPV. It has to work with the other agreements across the whole group. So they need to be reviewed together. And your law firm can help with that. And just a point here that only one company can be the video game development company for a given game. So the video game development company is the company that can claim VGTR or VGEC. There can only be one per game. So if you're working with a publisher, for example, or co-dev partner, you should establish in the agreement who is going to claim the VGTR, because obviously there's some significant financial benefits to claiming that. But my point here is that it can't be your SPV or your main co claiming it and also the publisher. It's one, it's one or the other. So intercompany invoicing and VAT. So this is where you have an SPV in place. You've got the two companies in place and you're invoicing between the two because they're operating at arm's length. Don't forget, it's as if you were running two completely separate companies that weren't owned by you. So everything has to be done at arm's length, and that includes raising invoices between the companies. So they should be raised at a minimum quarterly. Your legal agreements will dictate this. Important not just to don't leave it to the year end and raise a massive invoice, because if you were working with a true third party developer, they would not wait until year end to receive an invoice that covers a 4 years period. So you have to make sure that everything that you're doing with your SPV, it has to be on commercial terms. It has to be realistic. It has to run properly. It's not, the SPV is not just a dummy company that's there to, make as much money as you can on the claim. It's, it's an entity in its own right, doing its own development activities, and you're working with it and acting with it as you would any co-dev partner, if you like. So just bear that in mind. You have to raise full invoices in both entities with the correct VAT rate, whether that be 20% if you're not in a VAT group or 0%. If you are in a VAT group, HMRC love to see these. One of the first things, if an inquiry is open, one of the first things they want to see is the invoicing between the entities and a copy of the agreements between the entities. So that's baseline information that they will ask for. VAT group, I think we've spoken about this to death now, but it has to be in place before the first interco transaction. If you're going to go a VAT group, I would very strongly recommend that you do have a VAT group. allow plenty of time for it. A side note here that to include costs within your current year's claim, you have to make sure that those costs are paid within 4 months of your year end to be eligible. So if you've got a large invoice that is payable to a co-debt partner in the UK, for example, and for some reason you haven't paid that within 4 months of the year end, but you have included it in your claim, HMRC will basically ask you to strip that out and possibly hit you with a penalty. So just be mindful that if you do have invoices there that you've included in your claim, they have to be paid, physically paid within 4 months of the year end. That's also true for the intercompany invoicing as well. It has to be paid or net off. Yeah, obviously late or missing invoices, which I alluded to before, particularly the intercompany invoices, are a bit of a red flag. The arrangement has to be, it has to be commercially real. So moving on to the BFI side of things. So the certification process is still the same. Nothing's changed on that front. What has changed is HMRC and the BFI are working closer than ever together than they have previously. But let's go through some basics here. So VGEC, same as VGTR, you still need a valid BFI certificate, an interim or a final, at the point that you're submitting your claim. Just be mindful there of the timeframes to get those certificates. I think they're BFI working to around 6 to 8 weeks at the moment, but some can take longer. Your interims are only valid for 3 years, so fatal mistake is submitting your claim and not realizing that your interim certificate has expired, particularly if you're waiting on that money to come through to fund your runway. So just keep just diarise when it's 6 months out from renewal. You can renew those interims. If the game hasn't been released yet, you can just renew that. But it will take a little bit of time, so just bear that in mind. So for those of you who have submitted a BFI application, you'll be aware that you have to submit a cost report as part of that application. For the interim report, it's a best estimate. For a final report, it must include the costs up until the point of release. And what HMRC are increasingly doing is checking between your claims over time and the cost reports you've submitted to the BFI. They're checking for consistency. They're asking you to explain if there's material differences. So it's really, really important to get these right and aligned. Another question that you should really be asking yourself is, has your game pivoted significantly since your interim was issued? So say, for example, there's been a huge change in the game design. You've taken a different direction. The content might be completely different. You might have started with, English-speaking characters, and now you've moved to Chinese, for example. Anything like that that could potentially impact your eligibility just needs to be really closely monitored and advice sought if you think that really, if you submitted an application today, it might not be approved. And another really important aspect of that is that your game hasn't evolved to include gambling or any payout mechanics. So HMRC will not allow you to claim for any games that include gambling or payout mechanics. So that can be, when I say payout, that could be tokens that could be converted to cash. It could be anything that has a material, well, not material, but a cash equivalent value. So if you're offering to send people sweatshirts when they reach a certain level of a game, which is unlikely, but as an example, that sweatshirt could be sold, and that to them is a payout mechanic. And in that case, the game would be disqualified. And it wouldn't be disqualified just for the year. They would look back in time to see when these elements were added to the game and look to disqualify all your spend back to that point. And if those elements have been there since day one, all of your claims would be disqualified. And as I alluded to before, the cost reports submitted with your BFI application, they should be reviewed at each claim point just to make sure that you're still tracking against those and that there's no material deviation. And if there is, raise it with your accountant and agree the next steps there, which usually are liaising with the BFI. Okay, the AIF, which is the additional information form. This is the form that's submitted to HMRC with your claim. But a bit of a key tip here is it has to be submitted to HMRC before the tax returns filed. So if you file your corporation tax return and you haven't submitted your AIF, your claim's going to be rejected. And as most of you probably know, HMRC work to a 40 working day target to pay out claims. But if they reject your claim because it hasn't got the AIF submitted before the corporation tax return, your clock resets again. So, you could lose 10 to 20 working days at that point, and then they will come back to you and say, actually, your application is not complete, and we're going to start again once you submit it. So just be really careful with that. Broadly, the AIF, it needs project name, start date, etc., and the BFI certificate. But for VGEC now, what we have to include is the details of the connected party transactions and the basis on which they're priced. So this is, again, HMRC collecting all the data they possibly can about the connected parties. They want to make sure that they're transacting on a commercial basis. So on the face of that AIF, that has to be disclosed now, which, is really, really important to get right. Also, with your claim, you must submit a cumulative profit and loss per game, per claim period. And the numbers from that have to agree with the AIF submission. If anything doesn't match between the AIF, the game profit and loss, the corporation tax return, HMRC will just either reject it outright or open an inquiry to dig a bit deeper. So if you, in summary, the AIF, if it's well prepared, it does reduce the chance for an inquiry. If HMRC find that you haven't disclosed a related party, for example, they will be pretty interested in that and potentially open an inquiry. So you must be obviously completely honest, completely transparent, and make sure that your related parties, connected parties, are disclosed on that AIF. And new from the 6th of April 26th, there's a new supplementary page, a CT 600P, which is now required with the corporation tax return. If your accountants prepare your tax return for you and they also submit your claim, probably just worth asking them if their software can handle this CT 600P supplementary page yet, because I know of some vendors that haven't actually built the functionality for that. So without that, you cannot submit a claim from the 6th of April 26th. So just one to be aware of. So minimizing the risk of an inquiry, what it looks like in terms of robustness. As I mentioned, undisclosed connected party transactions, HMRC, they will not be very impressed with that and expect inquiries, possibly not even just in the current year, but backwards as well. Costs in the claim that don't align with the BFI reports. As I say, HMRC are cross-checking these now and really paying attention to what's being submitted. So please don't make up your cost reports, particularly the final cost report, which reflects the actual costs. Just be really, really careful and ensure that they, are defensible and actual real costs. So if your game has evolved materially from your BFI application, just ensure that it still qualifies. Just do a quick sanity check or ask your accountant to take a look to ensure that it's still going to meet the requirements, just so that there's no risk there. Gambling or payout, as we spoke about, just be really, really careful. So obviously, like everyone else, HMRC is using AI and open source to cross-reference their claims against the information that's out in the public realms. So here's an example for you. Studio's BFI application describes a puzzle game, but their socials describe a game with loot box and payout mechanics. So HMRC will come back, open an inquiry and say, well, we can see on your Steam page or wherever it might be that actually we think there's gambling going on here. And obviously this is something they didn't do a few years ago. They're digging deeper. The information is at their fingertips now. It's frankly quite terrifying what they're digging up. So be very careful that whatever you're submitting to the BFI and HMRC is in line with your public-facing comms, because HMRC will dig, and we've seen them dig, and it's amazing what they can find. Particularly, this is when an inquiry is opened, but they will be all over you like a rash, so just be really careful with that. Our advice, check your public-facing profiles before you file, and while you're preparing your BFI certificate as well, your applications, just check what's out there, particularly around start dates. That's that's one that can catch studios out if they're, they have a start date that they're stating is X, but really their socials say it's a different date altogether. Because again, HMRC will just open that inquiry, unfortunately. With your agreements, just a quick checklist pre-claim. Check your agreements are fully executed. That sounds ridiculous, I know, but so many agreements we see are not actually signed. They're drafted, but they're unsigned, which means they have no legal standing. Are they up to date? You can't, with your legal agreements, you just cannot get them one off and put them in a drawer and forget about them. They have to be reviewed at each claim point. You have to make sure that it's reflecting the current recharge rates, that you're invoicing according to those agreements, the scope of work still the same, etc., etc. So do not put them in a drawer and forget about them. Make sure they're fit for purpose. If you're not sure, check with your lawyer or your accountant. Really, really important. Make sure these agreements are consistent with your TPA or TPP and arm's length, as any new agreement could affect the calculated man-month rate that you use to recharge staff at. And I would suggest never, ever doing a file save as on an agreement that you've used for another project. It is just too dangerous. And also, you're actually not maximizing the possibility of, potentially increasing claims. So if you speak to a specialist law firm, of which we have a number of contacts that we can recommend to you, they might identify other ways that you can push costs down legally from the top code to the SPV. So, their advice alone could be extremely valuable. And if nothing else, it'll give you peace of mind that your agreements are, defensible. As I say, review the agreements every claim point, not just at year end, particularly for long projects. That's really, really important. And document all the overseas contractor and co-dev relationships. What are they doing? How's their work used? Who has the right to claim, etc., etc. We've spoken about the project start date a little bit. HMRC are really interested in this because it determines which regime you can use. I mean, obviously from the 1st of April 27, this is irrelevant, but for now it's quite important because a lot of studios want to claim under VGTR and therefore they might want to fudge their start date to pre-1 April 25. So be careful there. That's all I can say. Just make sure it's well documented. It's post-concept design. Start of development is after concept design. Ideally, you have documentation of that green lighting to move into the development phase. You've got design documents, project management tool records to substantiate that. And it's also disclosed on the AIF. So it's going to be cross-checked against your BFI application and any other public information. So just make sure they're all consistent. Cost reports, keeping the BFI and HMRC in sync. So we touched on this earlier. So the costs per your BFI applications are going to be compared against your claims if HMRC open an inquiry. So an example for that is your final application shows 800K in development costs, but your claim shows 1.4 million for the same period, which is a 75% increase. HMRC will likely want to understand why. And we're seeing that more and more commonly now. Just because it is, substantially higher doesn't mean it's going to be automatically invalidated as a claim, but you need to be prepared to explain why. And there can be many, many valid reasons for that. We had one particular client whose game went over by, it was around 3 million. And that's because they were developing different studios within the game with different features, but completely valid. But consistency between the two filings, i.e. BFI and HMRC, gives a signal to HMRC that everything is credible and well run. So increased risk exposure, just very briefly, because I know we're going to run out of time. HMRC passes information to the DCMS, who's the BFI certification team, and your certificate can be revoked, which can void your entire claim, which is obviously very, very scary. And misleading or deliberate claims errors can now completely void the claim. So previously it may have been adjusted downwards with penalties, but now your whole claim can be wiped out. Similarly, connected party transactions we spoke about, the profit element can be excluded. You'll probably get penalties slapped on you. And you've got the AIF as intelligence, which HMRC are using in respect of connected parties. They will scrutinize your group structure if they think something's amiss. What would void your entire claim? Just quickly, if the certificate was revoked because it doesn't meet the requirements of the BFI anymore, if you had gambling or payout mechanics in your game, which we spoke about earlier, fraud, negligence on the AIF or in the corporation tax return, HMRC can go back 20 years if they suspect fraud, which is just frankly terrifying. If there's a dispute about which company has the right to claim the credits, it can be disallowed. You don't really see that often. It's generally more clear-cut than that. But previously, if there was an issue, you might have seen a reduced claim, but now it's absolutely could be the entire claim voided, plus interest, plus penalties, which is not great. So what we're seeing now in practice from HMRC, they're asking details about the nature of the the connected party relationships. They want to understand how the parties operate, what the purpose of them are. They're digging deep now, whereas they haven't really before. They're using, obviously AI, AIF data, BFI applications, public-facing information, et cetera, et cetera. So they're really starting to build up, I guess, the knowledge within their team, but it's still early days. But this all means the inquiries are taking longer they're taking longer than under VGTR because HMRC are building the expertise at the moment. And sadly, scrutiny will only continue to increase. So just very, very quickly, what we're seeing is a move away from DIY claims, and that's probably not that surprising given the new risk profile of VGEC and the new complexities. So before we would see studios preparing their own VGTR claims and now struggling with VGEC just because of the complexities and the risk. The risk of HMRC voiding the claim is quite real now. And same, we're seeing, a lot of studios are coming to us that have used generalist accountants before, but I guess now there's an understanding that this is a specialist area of tax, and it's not just the tax computations, it's everything that goes with it. It's the AIF, it's the agreements, it's that whole holistic view of the claim. It's not just a bit of number crunching anymore. And the stakes are too high now. So that's what we're seeing more and more. People are coming across to specialists. So final thoughts. Don't be scared by all of this. This is just the way it is. I mean, like all things tax related, the scrutiny is increasing across all areas of tax. It's not just VGEC. It's not going to change. It's not going to go away, but it's still an incredibly valuable tax relief that really, all studios based in the UK should claim this. It's hugely valuable. It can prop up your runway, support your structure, support your studio completely in terms of cash flow. And with multiple claims per year, if you want to go down that path, it's just invaluable. Also, you've got the opportunities to seek borrowing, lending against your claims. If there's a delay in your claim because of an inquiry, you've got the opportunity to go and seek lending against that, which is amazing. So get your structure right, document everything. I can't emphasize that enough, or get somebody to help you with that as to what a good document pack would look like, including all of your agreements. Keep everything consistent across all of your submissions. And if you have projects before pre-April 25, just do the analysis as to whether switching to VGEC now is beneficial or whether you should wait until it's a must-do next year. I would say, 90 times out of 100, VGTR is more beneficial at the moment just because of those overseas contractors, etc. Get your interim certificate in early and seek specialist advice, not just from your accountants, but your law firm as well. It's, I would say, really important to get a law firm on board that are specialists in the game industry because it's complex. So, sorry, that took a little longer than expected. Leo, did you have any other questions come through?
Tremendous. No, thank you so much, Catherine. It's really, really helpful stuff. I think there's an awful lot of practical tips in there, especially around sort of the structuring of everything. I think we've had a question in the chat. I think it might be saying if all invoices have to be actually paid by the SPV, but the main company holds all the development funds, how does that work? I was under the impression it was the other way around, but am I wrong here?
Yeah, so there's a couple of ways that you can do it. Ordinarily, the invoices actually net off against each other. So instead of physically paying, you can net them off. So in your accounting software, you can say they're paid, but really no physical money has to move because they net each other off. The SPV doesn't hold the money, you're right, it doesn't hold the money. And that's why this netting off is so important to do, because you don't physically move the cash around. There may be instances where the SPV receives the claim money and then they would be holding that amount of cash. But what we ordinarily see is the claim monies come into the main co, and there's a tax-free dividend between the SPV and the main co to, legitimately move that money up to the main co. So no physical transfer has to be done because the HMRC have already paid it out to the main co. But you have to do the paperwork behind the scenes for the tax-free dividend to say, the video game development company, the SPV, has the rights to that money, but it's declaring a tax-free dividend to move that money to the main co. Does that make sense?
It does, but not in the way that I thought it would. So yeah, thank you.
That's okay.
Good. Tremendous. Well, we do have a couple of more minutes left if anyone else has any questions, but I suppose you have your details on the Eventbrite, and I'll pop them on the there we go. Yeah, super helpful. I suppose anyone can reach out if they're
keen of course, yeah. And I appreciate there was a lot of content that I covered off there. It's probably a slight information overload, but it's just to give you a heads up of what's going on. But if you want to delve into it in any more detail, just reach out. We can have zero obligation chat. I can help you sort of navigate the world of VGEC. It's absolutely fine.
Now, let's just have a quick look here. I'm going, Christopher. I'm going to create a recording, so I can send you that as soon as it's topped and tailed and edited. But yes, let's see if there's any other questions here. It doesn't look like it, but we'll pause there for the moment. And Catherine, thank you so much for your time.
Absolute pleasure. No, thanks for having me.
100%. Tremendous. Well, thank you again. Really appreciate it. We'll happily stay on for a couple more minutes, but fear not, everyone. I'll get a recording over to you as soon as possible, just so that you can delve back into this. It is quite dense and complicated, but I suppose ultimately you're here to provide that guidance and here to provide that support. I think it's interesting you're saying about the sort of the DIY aspect of VGTR claims in the past. I suppose there is just a lot at stake here for VGEC claims for to risk doing it themselves, really.
Yeah, that's it. And I think if the scrutiny was back, at the levels it was 3 or 4 years ago, that the risk is low of an inquiry being open, but it's just moved on so much, particularly with AI.
Yeah. Well, tremendous. Thank you so much again, Catherine. It's been a delight to have you.
Thank you.
And hopefully see more of you in the next couple of weeks or so. We've got, 8 more sessions of our Insight into Games months coming up. So yeah, fantastic stuff.
Oh, that's brilliant. Thanks so much again, Leo.